In my opinion, the quickest way to build net wealth is through the BRRR strategy. First and foremost, BRRR stands for buy, refurbish, refinance. Most people add another R on the end, which is rent, but sometimes I host my properties, so I tend not to bother. However, the fundamentals are the same. What we want to do is spin one pot of money. So most people might have anywhere from 15 to 50 grand to start their property journey off, which is typically their 25% deposit that they would have to put down to get their first investment property. Now, the old school way and the incorrect way to do it, which means that you'll scale very, very slowly, if at all, you'd be lucky to maybe get 3 properties in the next 10 years, is by investing all that money, leaving it sat in a property, and then getting £200 to £400 a month net income from that property. And obviously that then builds and builds and builds. Now, the quickest way to do it, and I didn't know this, for me, I was always thinking, why would I want to invest 20 grand to get £200 a month back out? For me, I just couldn't make sense of that in my head. But then I discovered the BRRR strategy. But at first, I was skeptical, maybe like you are right now, where I just thought, does that really work? Does it actually happen? And in all fairness, even throughout my first deal, until I got the money back in my bank account from my solicitor after the refinance part of the whole strategy, did I believe it actually worked. So what you do is you buy a property below market value. Typically a property that needs refurbishment, maybe a deceased estate, or it's been lived in for 20, 30 years and then the owners have moved into care maybe, or a motivated seller. They just need to sell that property, maybe financial circumstances have changed, they're relocating to a different location or country, and they just have to sell that property quickly and will take any price to get it gone. So a few combination factors, but the main thing about BRRR, making sure you execute it, is to get the property below market value. What we then do is we then spend money on the property and we improve the inside, the outside. We just add value to the property, and we need to be adding value to be able to then go back to the mortgage lender and ask them for more money. Because what we're doing is we're taking the property from a unmodernized state typically to a nice modern market value condition, and therefore the value will come out and say, yep, that is now worth that. So that in brief is how it works. Now, I get questioned a lot, does it actually work? And a lot of people can't understand the numbers. So what I'm going to do for you on my phone, I'm going to go through exactly a typical deal, try and keep the numbers as straightforward as possible to show you briefly how it does work. Whilst I've still got your attention, if you're enjoying this video content, then there's plenty more where it came from. Don't forget to hit the bell notification and subscribe to the channel. And there's links in the description which give you other videos exactly like this one to help you on your property journey. So let's just use round numbers for argument's sake. So if we buy a property for $75,000, now I would typically take it on a bridging loan or I'd cash purchase it. A lot of people think doing mortgage to mortgage is the right way to do it, but first and foremost, it's technically against the mortgage code of conduct because you shouldn't use long-term finance for a short-term solution. So bridging loan really should be your option. Now with bridging loans, you need to put down a 30% deposit. So 30% of 75,000 is 22,500. Now, 75,000 minus 22,500 means that we will be borrowing 52,500 from the bridging company. So they would give us 52,500 and we would put the 22,500 in and we would acquire that property. We would say spend, let's say for argument's sake, £7,000. That would be maybe a new bathroom, a new kitchen and a bit of decoration. So we've taken the property from an unmodernized state at 75 grand. And we're then going to spend £7,000 on it and then put it into a modernised condition. I'm not going to cover fees, stamp duty, bridging costs, etc. during this video because it'll complicate it. I just want to keep it fairly simple for now so we can understand how the strategy works. If we then get the valuer back out and we go for £100,000 valuation, we then get a 75% mortgage on that property and that will then pay the bridging loan off. So we then get £75,000 back out of the property. Our original bridging loan, remember, was 52,500. So we minus 52,500. That leaves us with £22,500. We have spent £7,000 on it, so we have a pot of money of 15,500. That is cash back. Now, if you want to then get into the complexity of it all, we would have had stamp duty around £2,500 to pay, solicitors' fees of probably a couple of grand, and bridge and loan fees of a couple of grand. So let's just say, in argument's sake, there's another £6,000 to come off that. £9,500 cash back for buying a property. Me personally, I don't take cash back. I like to just keep the properties lowly geared. However, if you have a small amount of money and maybe you want to try and acquire as many properties at the beginning, then yes, take the cash back, leverage yourself up, and then buy more assets with that. And as long as you refinance and you're getting the money out, then it works. Now, the key in this is not getting your money stuck. Let's say, for example, I paid 75,000 for the property, so we borrowed 52.5 grand from the bridge and loan company. We spent 7 grand plus 6 grand fees, and we only got an 85,000 valuation. So we get 85,000 times 75% mortgage is 63,750. We minus our 52,500, which is to pay the bridge and loan company back. We're left with 11,250 quid. We take away our 7,000, 4,250 quid left, minus our 6,000. We would still have 1,750 tied into that deal. 1,750 quid left in the deal is actually a very good deal. My model is 24 months cash flow has to be out. So if we break the figures down even further, so we go a bit tighter on the numbers, let's assume we actually only got an £80,000 uplift. So we times that by 75%, we get £60,000 back from the lender. We pay off 52,500, which leaves us 7.5 grand. That's pretty much our refurb cost, so we would end up leaving 6 grand in the deal, which would be our solicitor's fees, bridging costs, etc. So we then say that on average we get £250 profit as a single let from this. So we divide the 6,000 that we've got left in the deal by £250. That's going to take us 24 months exactly to get all of our money back out. And then once that money's back out, we have no money of our own invested in that deal. The only thing we have outstanding in that deal is the mortgage. Now, the tenant's going to pay the mortgage. Whether you go interest only or repayment, this is massively up for debate. I have a mixture of both. In my mind, I want to gear my portfolio down to 55% loan to value, but a lot of people say you should keep it as interest only because you'll earn more from getting another property than you will paying down your mortgage, and over time property will uplift in value, so naturally your loan to value will go down. But the idea of this video is not to get too much into that. It's more about understanding the strategy and how it works. If you get your money stuck at the beginning, if I invested, say, my deposit and I put all my money into the deal and I didn't get it back out, then it's stuck. So let's say 22,500 that I put in this deal at the beginning, if I didn't get the uplift value and I'd spent the money, etc., and I still have my 22.5 grand stuck in it, if I divide that by 250, that's going to take me 90 months to get my money out. 90 months is 7.5 years. So 7.5 years waiting for that money to come out. As you can see, that's the end of your game. You ain't going to be moving quickly. You're going to have one property for the next 7 to 8 years because you'll have tenancy voids, you'll have refurbishments to do. So you won't necessarily make 250 every single month. So the key is in making sure that you buy right. A bit like the rent-to-rent strategy, you want to make sure you're renting right. You've got to buy right. If you acquire properties right, and you get your comparables correct and you know that you're going to get that uplift in value, then the deals are no-brainers and you go for it and you turn that money very, very quickly. And for me, that is the quickest way to build net wealth. Thanks for watching this video. There's plenty more awesome content where this came from. As I said, don't forget to subscribe to the channel and continue watching the videos. And if you really want to get ahead of the game, then join my private Facebook group. Just head over to Facebook, 7-Figure Property Empire. Click the link to join and we'll get you on the inside.